Hey guys, this is Rudy coming at you live from Palm Beach in Florida. It is June, it is the 12th, it is Monday. And today we're going to talk a little bit about energy and specifically energy transfer. So let me get this presentation up here and get the show on the road. So what I want to do is spend a little bit of time just talking about energy transfer in general, and maybe look at the macro from an energy point of view, and then perhaps compare energy transfer to four other pipeline companies. Now, Energy Transfer is a very diversified energy company, but its primary business is pipelines. So it would be fair to compare it with some other pipeline companies. But let's just chat about this just for a minute. So many people ask, why does the energy price just keep crashing? Now, there's a supply and demand curve that's very much in favor of energy investors. There are a couple of things that we expected to happen that did not happen, such as a quick recovery in China, for example, the pending doom and gloom of the recession. And I'm not suggesting that the recession is not going to happen. I don't even want to talk about soft landings or hard landings. But what I do want to do is acknowledge the fact that we are in a recessionary climate. We have high interest rates, and some of these things are impacting energy as we know it. For sure, the high interest rates itself have actually caused a little bit of downward pressure on the energy price. And the reason for that is that it makes sense for companies to sell their oil as opposed to sitting on the inventory, because they can earn an extra amount on the cash, whereas the commodity itself might decline some more. So it makes sense to actually turn inventory into cash. A couple of other things that have also happened is very recently the Brent benchmark has been changed to include WTI. And for those of you who follow energy, you would know that there's always been a delta with Brent being higher than WTI historically. And the difference is quite significant. So if you take the two, you add them together and you average it out, that causes a little bit of downward pressure as well. And then the other thing that comes into play is many people think that if OPEC cuts, then it should automatically be a bullish signal for the energy market. That's not strictly true because of the sweet and sour disparity between the different oils. So if you compare the Saudi oil, primarily Saudi oil from an OPEC plus point of view, it's a sour grade of oil, and the crude that most countries like Brazil and the United States are producing is mostly what is termed as sort of sweet crude, right? So I haven't personally tasted these myself, so I can't tell you if they sweet or sour, but it's basically related to the amount of sulfur in the crude that they're producing. So as a result of the sort of production of US and Brazilian crude, which is predominantly sweet, which means it has a lower sulfur content, it is causing a bit of downward pressure and making that's an oversupply example. And the cuts from, let's say, Saudi Arabia, which is predominantly the sour crude, is not having as much of a bullish impact as it should. Now, before I continue, I've said this before and I'll say it again. I've said it many times before. The commodity and the supply and demand as it relates to crude specifically is less important than the traders, right? So the people who trade the commodity, the Morgan Stanleys, Goldman Sachs, UBS, etc. of the world, they are within the energy sector kind of viewed as the largest energy companies on the planet, not Exxon and Chevron and Saudi Aramco and companies like that, right? So in a way, it's a little bit of tongue-in-cheek, but on the other hand, it's just a matter of fact, right? The traders determine the price rather than the pure supply and demand curve as it relates to some other commodities. Let's take a look at energy transfer. I took the snapshot today, so just earlier, it's 4 o'clock Eastern time, June 12th, so it's current. You can buy energy transfer for about $12.50. It's a mid-cap large oil company, $40 billion market cap. It's cheap based on its PE ratio, so price earnings ratio for the trailing 12 months is less than 10. That's pretty attractive. It's very attractive for old guys like me because of the dividend yield. The distribution on energy transfer currently at $1.23 is almost 10% based on the current stock price of $12.60. That's easy math, right? So $1.23 is almost 10% of $12.61, which means it's distributing almost 10% on an annualized basis to investors. And Energy Transfer is one of my largest positions, so I view it pretty much just as a high interest yielding savings account. Sitting sort of to the right of the 52-week range. Short interest, about 4% of the current outstanding float. I would be very nervous to short Energy Transfer at the current price of $12.61. In terms of my back of the envelope math, Energy Transfer is about an $18 stock. But, you know, the stock price is not necessarily related to the commodity or the company or its fundamentals. It's more related to emotion. What do the smart people say? So you can go to this site if you want to do a quick snapshot on DCF, which is discounted cash flow, valueinvesting.io. And they say, unlike my back of the envelope math, it's not an $18 stock, it's a $17 stock. Well, you know, I'd be okay with that too, because that's about a 30% upside from the current trading price, which is obviously $12.61. So over 30% upside according to valueinvesting.io. For me, about 35% upside. But hey, I'm not trading Energy Transfer. I'm just holding it, as I just said, as a high interest yielding savings account. And it has served me pretty good over the past couple of years or so. How good? I'll show you the chart in just a minute. Energy Transfer, of course, is in the oil, gas, and consumable fuel industry. It seems to be fairly valued with a PEG. So this is the price to earnings ratio or earnings growth ratio over the trailing 12 months of 1.84, which is in line with the industry. We look at the price earnings ratio, the PE ratio, trailing 12 months based on its GAAP reporting. So just under 10, the industry is at 6. So if you shop around, you could probably find better buys than Energy Transfer right now. But I'm not buying Energy Transfer. I'm also not selling Energy Transfer. It's just a hold for me. I'm just sharing information with you. The price to book for the most recent quarter, 1.5, compared to the industry, 6.6. And the PEG, so price earnings growth ratio for the trailing 12 months, 1.8, compared to the industry's 0. Fair value, sort of based on most benchmarks. It's fair value at the current price of around $12.60. If you want to open a position in Energy Transfer, you could probably do it at $12.61. But you know, if you just hang tight for a while, it might even drop a bit more. You can buy some more. If it drops a bit more, I'll probably buy some more too. But for now, for the most part, I'm just holding it. How about profitability? Well, it's underperforming its peers here, even though according to the sort of macro thesis, the margins are in line with industry medians. Over the trailing 12 months, the gross profit's been about 20%. The industry is 40%, so it's at half, performing at half the operating and gross profit margin of the industry. Operating Energy Transfer trading 12 months, 9%. The industry is at 24%. And net profit, only a third of the industry's 18%. It's generating 6.5%. And it's a little bit of a different company because it's so diversified. Obviously, its pipeline business is based on contracts, and that's just moving the stuff, right? So the crude, the natural gas, etc. But Energy Transfer also owns Sunoco, which is retail. And then they have some diversification in other areas too. So Energy Transfer is not a pure play oil and gas and consumable fuels industry that you can easily compare peer to peer. So even in a minute or so, when I give you a comparison with 4 other pipes, they're not necessarily the same. Energy Transfer pays this huge dividend, which is obviously the primary reason why I'm holding it. And I'll probably hold it for at least a few years more and see where it goes. I mean, if I also get a 30% uptick in the stock price or the unit price, because it's a limited partnership, which, by the way, also means that not everyone should hold Energy Transfer in their portfolio. I know for international viewers of this channel, they've educated me several times in the past in terms of their tax withholding rates and so on. In addition to that, you don't really want to put Energy Transfer or a limited partnership or master limited partnership in a deferred tax account like a retirement account, because it's sort of a contradiction in terms. But I would certainly hold it here. If it's in your account, you can hold it for sure. I wouldn't want to sell it at the current price. $12.60 is not a great sell price. You can probably do better than that. But the dividend has been pretty good. And we're going to talk about the dividend more in just a minute when I wrap it up, and I'll tell you why it's okay to have Energy Transfer in your portfolio. The dividend growth rate over the last 3 years looks horrible, but that's because of the huge dividend cut that they had during the pandemic. So financial strength right now, you always know that I look at the financial strength, and very specifically, I look at the quick ratio, how much cash in the bank compared to bills that are due, and the interest rate coverage or interest coverage for the most recent quarter. Now, in total, sort of looking at the total debt to capital ratio, this is very high. Energy Transfer has been paying off some debt, but they've also been doing other things. Obviously, they distribute a large amount of their free cash flow and cash to investors. Once again, that's why I hold it. And at the same time, they've been doing some share buybacks. But the debt to capital ratio is quite high. But it's comfortably high for Energy Transfer. So it's one of those sort of catch-22 situations, right? I don't really like to see the debt to capital ratio at over 50%, but at the same time, they have no problem repaying the debt or servicing the debt, right? So the interest coverage down here at the bottom is 3.7, which is good, despite the fact that the industry is at 12, right? So Energy Transfer is lagging, but it's pretty good. From a quick ratio point of view, so this is how much cash you got in the bank compared to how many bills you have to pay within the next month or so. We need to be at 1 or above. The industry itself, sort of overall, is at around 1, which is okay. The more it is above 1, the better. Energy Transfer is just below 1, so we don't want to fly too close to the sun here. We actually want to get the quick ratio above 1. If possible, the difference between the current ratio is cash and cash equivalents, right? So cash equivalents can include other things like investments and inventory and so on. Quick ratio is cash. You definitely want to be at 1-to-1, right? Think of it from a personal point of view. If you have to pay your mortgage and you have to pay your car and you have to buy food, and let's just say, for the sake of argument, that's $1,000. You don't want to have $900 in the bank because you're short $100, right? Because otherwise, next thing you'll be cutting down your food bill in order to pay your expenses. You don't want to be in that kind of position at all. So 1 or above is good. Just from a personal cash management point of view, you always want to have like at least 3 months worth of cash on hand in terms of whatever your ongoing expenses are. As a conservative and older person, I actually like to have much more cash than that. 3 months is just not enough. For me, a sense of comfort is maybe between 6 and 12 months worth of cash on hand. But if you are young and you have low expenses and a reasonably decent income, you can adjust that a little bit. But maybe 3 to 6 months worth of cash is always good. You never want to fly too close to the sun in terms of cash burn. People who watch the channel on a regular basis will know that the screens I'm sharing with you now are from Tip Ranks. We have 8 sell-side analysts here who have a strong buy rating on Energy Transfer. No one's saying hold, no one's saying sell. I'm actually saying hold, but that's because of where I'm at. Strong buy, the average price sort of in the $15, $16 range. There have been no downgrades on the stock recently. Most of the analysts, especially the analysts that have high ratings, like Jeremy Tonet from JP Morgan with his 3.5-star rating, has a maintained rating on the stock with a price target of $18. So Jeremy and I are kind of on the same back of the envelope there with an $18 price target. A quick snapshot here, still with Tip Ranks, outperformed 9 out of 10. 10 is the highest, so 9 is pretty good. Analyst rating strong buy, insider activity bought. Technicals positive, the fundamentals are somewhat positive. The asset growth has been declining a little bit. I try not to spend too much time reading the news, right? I don't want to be one of those guys who is buying or selling based on the news or sentiment. I don't want to get emotionally involved in my stocks. I just want to hold them in order for the return on investment, and of course, in the case of Energy Transfer, for the ongoing distribution that I receive as a unit holder. The blogger opinions, bullish, doesn't really matter to me. The investor sentiment overall doesn't really matter to me. But I do like the insider activity. I like to look at that. That's a pretty interesting little snapshot that you can take from any equity that you are invested in. What are the insiders doing? Are they buying or selling? So I just said I don't really like to look at the news update, but I saw this news update, so I just thought I'll share a screenshot. Just recently, in fact, on Friday, June the 9th, 2023, the appeals court dismissed a GOP mega donor. So for those people who are outside of the United States, the GOP is the Grand Old Party, which is sort of the other acronym for the Republicans. So a GOP mega donor, he filed a lawsuit against a Democrat guy who was running for governor of the state of Texas. His name isn't Beto O'Rourke. It's actually Robert O'Rourke. He just calls himself Beto in order to appeal to some of the minority groups in the United States, because he is not Hispanic by any means. But the guy who filed the lawsuit against him was billionaire Kelsey Warren. And he claimed that he had been defamed by the Democratic candidate's criticism of the power grid failure in Texas in 2021. Now, it actually went to appeal, and the appeal court dismissed that lawsuit. So Beto O'Rourke will probably be overjoyed by this. I should call him Robert. And Kelsey Warren will probably be a little bit annoyed by the fact that his lawsuit was dismissed. But hey, the politicians and the rich people are always at each other's throat. If Kelsey Warren was a supporter of Robert O'Rourke when he was running for governor, then they probably would have been good friends. But take a look at this. This is the same Kelsey Warren, right? So the big boss man of Energy Transfer, just in the last month, right? I took this snapshot on Friday. So that was June the 9th, on the same day that his lawsuit was dismissed. So just in the last month, 16, 17, 18 days ago, 24 days ago, 25 days ago, he's been buying little tranches, small little tranches of Energy Transfer, 4.5, 5 million, 9.5 million, 12 million, 6 million. How much is this? 18, 28, and another 9, it's about 30, 40 million dollars of stock he's been buying over the last month at that same price, at around, 12 bucks or so, because $12.50, $13. Energy Transfer hasn't moved much. And Kelsey Warren has been buying. These are informative buys, right? So he's an insider because he's the executive chairman of the company. He's co-CEO and a director. So he's been buying a lot of stock, So there's a really good chance that Kelsey Grammer knows some things about Energy Transfer that you and I don't know. So if he's prepared to drop $40 million of his personal cash doing open market buys, these are not stock options or restricted shares or performance shares or whatever. These are buys, So very, very interesting how much is actually bought. Let's take a quick look at Energy Transfer here. If you look at the ratios on a quarterly basis, the return on assets, return on invested capital looks pretty good. Return on assets, 28%, return on invested capital, almost 20%. Cash flow, very good year over year, 51%, but this is for the quarter, and 40% operating free cash flow for the quarter. How about if you look at it year over year? A little bit less good, right? So the return on assets, negative 17% on invested capital, 24%, which is okay. The cash flow actually looks less good, right? So that's also one of the reasons why I say, for me, Energy Transfer right now as a whole, it's not a buy. If the price drops for the units well below 12.60, I might be tempted to get back in. Let's do a quick comparison with 4 other pipes, and then I'll wrap it up here. So in case you've forgotten, weighted alpha is a measure of how much a stock has risen or fallen over a 1-year period. Well, it's not really a 1-year period. It's actually 250 trading periods, which is about 1 year. The weighted alpha is positive for Energy Transfer, 11, whereas for the other 4 pipelines here, it's negative. So right at the bottom of the screen, you see Energy Transfer on the left. I'm comparing it to Pembina, which is also one of my larger holdings, Kinder Morgan, on which I don't have a position at all, Enbridge, on which I do have some positions which are smaller now because I swapped out some Enbridge for Devon Energy, and then Oak. So at the bottom here, you can see the 4 companies that are predominantly pipeline type companies that I'm comparing Energy Transfer to. And ironically, the only one of the 5 that has an overwhelming rating of buy from the analyst is Energy Transfer. Now, if you're a contrarian like I am, that probably means you should sell Energy Transfer and buy all the others, right? But not so fast. There are good reasons why they say it's a buy. I'm not saying it's a buy. I'm actually saying it's a hold. So I have a bit of a differing opinion there. If we look at the 20-ray raw stochastic, it's just above here. If it's 80% or higher, it's overbought. Two of them, Kinder Morgan and Enbridge, are sort of nearing the overbought range. The rest of them are still sort of okay if technicals is your thing and that's what you like. How about performance? So ironically, on a 6-month basis, we can ignore everything above 5 months, 1 month, 3 months. I don't really care too much about that. I'm more in it for the long haul. I've already been in Energy Transfer thanks to Bulldogs #1, who originally drew my attention to it since, wow, more than 2 years now, right? So anyway, over the last 6 months, it's given me a return of about 11%. That's in addition to the distribution of almost 10%. And as you would know by now, if I can afford to do so, I take my entire distribution and just buy more stock. That's called a DRIP, a DRIP, a dividend reinvestment plan. I don't even see the cash. I'm enrolled in an automatic DRIP. The minute they pay me a distribution, I just buy more shares at whatever the price is. Over the past 6 months, the other 4 pipes, including my Pembina, has been giving me a negative return, and so have most of them. So the market, the energy market, is mostly depressed for the most part anyway. So it's been struggling a little bit. Look at this metric here. This is an interesting one for me always, right? Annual sales compared to market capitalization. Energy Transfer is doing $89 billion, almost $90 billion in annual sales. It's got a market cap of only 40 billion. Only 40 billion, right? The annual sales revenue is more than 2 times the market cap of the entire company. Market capitalization, just for in case you've forgotten, or market valuation. The number of outstanding shares of units multiplied by the stock price gives you the market cap. All the other companies are kind of like normal, right? So Pembina over here is doing about 9 billion in sales, market cap 2 times that. You got Enbridge, so Kinder Morgan over here doing about 20. The market cap is 2 times that. You got Enbridge doing about 40. The market cap is 2 times that. And then there's a little outlier here, 22 billion in sales, 27 billion market cap, but nothing like Energy Transfer, generating $90 billion in sales with a market cap of only $40 billion. They all have positive earnings, as you'd expect, since also because the commodity price is fairly high. They're all relatively cheap based on their price earnings ratio. Energy Transfer is the cheapest of the lot. So if you were thinking of buying a pipeline or some midstream company or whatever, of these 5, for instance, on the screen right now, Energy Transfer is probably your best buy. So maybe that's of interest to you too. If you look at the chart over the last 2 years, I just said that I was in Energy Transfer for at least about 2 years or so. It's been good to me. The return on investment here of around 20%. If you include the DRIP, so my reinvested dividends, so over the past 2 years or so, Energy Transfer is up about, I think it's about 46, 50% or so over 2 years. It ain't half bad. It's been performing pretty good. The laggards here at the bottom, so Pembridge and Kinder Morgan being the worst performing 2 of the 5, actually 3 of the 5, Enbridge is in there as well. But Energy Transfer has been a good performer, not only from a return on investment point of view, but also as a result of the dividends that have been increasing. So if you want to buy it, what's to like? So first, we need to revisit history just a little. So the distribution cut in 2020 came about as the energy industry witnessed a demand drop because of the economic closure, due to the pandemic. And that was reasonable given the circumstances. So, but since then, Energy Transfer has increased their distribution or dividend 6 times, pushing it to above where it was prior to the cut. And in the first quarter, the distributable cash flow, sometimes people talk about free cash flow. If it's a limited partnership, you can talk about distributable cash flow, was roughly 2 times the total distributions that was paid out, which means there's ample room before there would be a risk of a cut again. So guys, like in a nutshell, that's sort of my take on Energy Transfer. As I said a couple of times during the presentation, for me, it's a hold. It's not a buy. You can buy it at 12.61. It would be okay. It might pull back a bit more. As I said, my kind of guesstimate is it's more like sort of $18 stock. The valueinvesting.io discounted cash flow site says it's a $16 stock. That's where we're at. That's Energy Transfer. It's one of my largest positions in my long energy portfolio. I just hold it. I have no plans to sell it. I'll just keep banking the distributions and using the distributions to buy more stock at whatever the price is when the distribution is paid out. So that's where I'm at. That's Energy Transfer. Don't sell it. If you're long, don't sell it. And if you don't have it, maybe look carefully at what's available in the marketplace before you buy it. On that note, this is Rudy saying thanks for watching. Take care. Bye-bye.